RSI trading strategy. Hey guys, and welcome back to an exclusively new video on my channel Tradingfyive. And today in this video we are going to discuss about an indicator, a momentum indicator, which is the RSI. You see, if you have spent some time trading in the stock market, or even if you have watched at least few of my videos, then you must surely know about this RSI indicator. You see, RSI is a momentum indicator, that is, it will indicate us the speed of the market, which means the rate at which the market is going in uptrend or in downtrend. And today we are going to discuss about a concept in RSI, which is the sharp move, or you can say loud move. You will understand about them in this video, and you will even get to know that how can these loud moves on the RSI can make you suffer big losses in the market. So guys, if you don't want to miss something that can help you a lot in your trading, then make sure that you're watching this video till the end. Do not skip it. And if you find this video helpful, make sure that you subscribe to our channel and press the notification bell so that you won't miss such amazing videos on technical analysis and trading. Alright guys, so you see, there are two models, or you can say two methods of trading on the RSI indicator. The first method is the RSI 70-30, which is kind of traditional method of trading on this system. And in this method, if the price is going above 70, it is considered to be as overbought. That means there are enough number of buyers in the stock, and chances are that these buyers will start booking the profit and exit their trades, which can cause the market to give a correction or go in a slight downtrend. In this overbought zone, people usually think that the market is forming a top and they find opportunities to short the stock. And similarly, when the price goes below 30, it is considered to be oversold. And we have the same anticipation over here that the market will form a bottom when the RSI is in oversold zone, and then we can look for buying opportunities. But let me tell you that this method of trading RSI is completely wrong. You see, this method of trading RSI is being used since lot of years in technical analysis. But right now, if you look at the market, if you compare the price and RSI, you will find that this method is giving negative results. Instead, we prefer using an unconventional way, which is the RSI 60-40. So in this RSI 60-40 method, when the price crosses above 60, we consider it to be as bullish. And just opposite to this, when the price goes below 40, we consider it to be as bearish. So whenever the price enters any of this zone, that is crosses above 60 or below 40, we look for some trading opportunities on the chart like the breakout or breakdowns, as we have got the confirmation that the market is going bullish or bearish. Let me show you with some examples. So as you can see on the screen, I have a daily chart of Nifty, and this is like a past data of this index. You can see that the RSI in this region is continuously above 60, and so the price is in a good uptrend, and we could have looked for many buying opportunities in this scenario. And again, this is like another example where the RSI is above 60, and at a point it has even crossed 80, which indicates that the price is strongly bullish. So here is where we must look for buying opportunities in the market rather than looking for selling the stock. And again, you can see this is an example where the RSI is below 40 and the market is moving in a sharp downtrend. So in this case, looking for a buying opportunity over here will be completely stupid, since the market, the RSI indicator, is itself telling us that this scenario is bearish. So we have to go according to the market, we have to go according to this indicator, and it is just like catch the trend, go along with the trend. So this is the story of how RSI indicator works in the market. Now there is one question which might puzzle you, which is why RSI above 7 should be a concern for you. I mean, if the RSI is above 70, it indicates that the market is going bullish. We must look for buying opportunities because we are expecting a strong uptrend in the price. So why is it that the RSI above 70 can make you big loss? You can see on the screen that the RSI is above 70. In fact, it is nearly at 80. And the price is giving strong returns to the traders. So how can this scenario backfire? How does RSI going above 70 can make you a big loss in the market? Let me explain you. You see, there is a concept in RSI which is called as the loud move or sharp move. You see, over here the price gave a very fast correction. You can see gap downs followed by a big red candle. And this causes RSI to go from 70 to nearly 40 in just span of 2 or 3 candles. And this is what is called as a loud move on RSI, a movement in the price which is very fast. And this fast correction in the price can make you big loss in the market. And let me tell you, we usually find these loud moves in RSI at the 70 level or above it. Let me show you one more example. So you see, this is a loud move which caused the price to correct very quickly. And you can see the RSI went from 80 to 60 in just 3 to 4 candles. And again over here you can see when the RSI was at 70, we could see a loud move in the stock. And this is one of the problems that many traders are facing while trading on RSI. So how can you overcome this thing? The only thing you can do is that follow your risk management properly. If you have done proper position sizing, if you have defined your risk well in advance before taking the trade, then the loud move should not be a problem for you. You see, most of the traders in the market don't do risk management before taking a trade. They don't define their trades, they do overtrading. They trade with the quantity which is outside the capacity. There are high chances that you will make a big loss in the market. So to overcome this problem with RSI trading strategy, you have to strictly follow risk management. And the second thing what you can do is you must look for low risk entry. That means your buying price must not be too far than your stop loss. In that case, you can easily make a perfect trade, and even if you go wrong or you get trapped by the loud moves, then you can still exit with a very small loss. Alright guys, so lastly, thank you for watching this video till the end. If you found this video informative and helpful, make sure that you like it, share it with as many traders as you know. And lastly, to not miss such many contents on the stock market, technical analysis and trading, make sure that you subscribe to this channel and press the notification bell. Alright, and I will see you in the next video.